Hi, everyone. I'm Angela Giroux, publisher of the Bauman Letter. We are back with another edition of Your Money Matters. I am with Ted Bauman, editor of the Bauman Letter, and Clint Lee, research analyst. Welcome, gentlemen.
Hey.
If you'd like to check out the Bauman Letter, there's a link below. We just put together some great new reports for new members. I think they could benefit any investor. You want to check those out. We're coming to you today. It's Friday, September 25th. That means September's almost over, which I'm sure everyone is very relieved about. I'm sure you guys knew this, but September is, I know it's a bad month, but it's the worst month for stocks since 1950. And I think we could all agree that this September in particular has been very gruesome. You guys have been writing about it and doing videos. So much uncertainty politically. The Fed is running out of ammo. COVID cases are rising. So Ted, with all of these obstacles that we are still facing, what do you see happening next?
Well, I think it's useful before we do that. Let's look at what has happened so far this year, because I think it paints a really interesting story. I have a couple of charts I want to share. The first one shows the distribution of returns for companies for the S&P, but it shows two different dates. One is how things looked before COVID started. That's the green columns. And the second one is the way things look now. And as you can see, the percent of companies that were, for example, have suffered a loss in stock price of 25% around that was almost nil in February, but now it's 23%. So there are some companies that have not benefited from this big run up. However, there are a number of companies pretty evenly distributed across the top that have actually done reasonably well. So the question is, who are those companies? And I want to show another chart here. This shows very, very clearly that by market cap, it's the big players that have made big gains this year. It's been the biggest players. Obviously, 200 billion is almost small cap compared to some of the big tech stocks these days that are in the trillions. But as you can see, the big returns have gone to the big companies. Small companies have really suffered. That was not the trend at the beginning of the year, at least not to the same magnitude. Next chart I want to show shows the return for the years to date, or year to date, according to sales growth. And here's, I think, something that is actually a good reflection on what's been happening in the market. Companies with big sales are getting big price increases. That's what's supposed to happen in the stock market. So companies that have seen the biggest gains in returns this year are those that have been increasing their sales by more than 20%. And of course, those tend to be large technology companies, the ones, in the excess 200 billion market cap range. The last chart I want to show shows companies by forward PE ratio. And here's where the problem lies. As you can see, companies that have forward PE ratios that are fairly low, which means that they're cheap relative to earnings, have actually seen declines in prices this year, which is odd because you'd think that they were in value territory. The biggest gainers are those that have price earnings ratios of greater than 50, almost 20% of them. And that's really, I think, part of the problem. The issue here is that we have seen people pile into very large companies that have growth, but the growth in sales is not as big as the growth in their stock prices. And that means that they have pushed their PE ratios up to levels that may not be sustainable given the headwinds that we're facing. I've spoken about them in my videos. I think the Fed is no longer a player when it comes to the stock market, in the sense that there's no further lower that stock or interest rates can go, right? I mean, any tailwind from that is done, and anything else the Fed does in terms of quantitative easing doesn't affect the stock market directly. It affects capital and credit markets. So what are you going to do? Clint, I know you've got some takes on what those headwinds are likely to look like.
Yeah, so even to Angela's point earlier about seasonality, yeah, September gets a bad rap because it is. But then if you specifically look at just election years, September and October tend to be the worst, and that's to be expected because of the uncertainty of what the outcome of the election means for policy, how that impacts the economy and the markets going forward. And that's especially true right now. I mean, look, we've already got the uncertainties over, we've got high unemployment remaining. We've got the momentum in the economy's starting to wane again. The fiscal stimulus is uncertain right here, but we've seen this V-shaped recovery in the market, but there's a lot of clouds surrounding, are we going to see a similar V-shaped recovery in corporate profits? And that's what really matters right here. And I want to show you a chart just to illustrate that point. I mean, at the end of the day, the value of an index, the value of a stock, I mean, it's what it earns and it's what people are willing to pay for those earnings. Now, right now, that what people are willing to pay, it's a PE ratio. We know, I mean, it can go higher, but we are at the high end of our historical range. So really what we need to see to support the markets is a continued recovery in earnings. That's what I want to show in this chart right here. Is just in the last 20 years, this black dash line is the S&P 500. The green shaded area is the trailing earnings for the index. Every time the market's made a new high, that has been supported by a move in earnings to a new all-time high. Now, if you look toward the right-hand side of the chart, it's kind of hard to see, but we know we've got the S&P 500, you know, right around all-time highs, but we've seen this big dip in earnings. And so now the picture becomes, or the question becomes, what does this look like going in the next year? And the election outcome has a big implication for this. And a lot of that even revolves around just tax policy. You know, corporations have seen a huge windfall from corporate tax reform we had the last couple of years. I mean, just take a look at corporate effective tax rates for the S&P 500 right here. This is for the last 4 years. The effective rate was running right around 25% for 2016 and 17, but then tax reform brought the headline rate down to 21%. The actual effective rate, as you can see here in 2018 and 19, has been running right about 18%. Now, the reason I bring this up is because Biden, who's leading in the polls, he's wanting to reverse, you know, part of that cut, take the 21% up to 28%. So this is where it starts to impact the earnings picture. So if we look at what earnings estimates are for next year, they're about $162 a share. That would be a new high. We peaked out in 2019 around $157 a share. But let me show you a chart right here that shows different scenarios with the tax hike put in there. If Biden wins and is able to get the tax hike put through, then 2021 estimates, this is research put together by LPL, that goes from 162 down to 146. So we're still below prior peak in earnings. Even if you get the removal of tariffs, you're still at $154. So once again, you're still below that prior peak in earnings. So the earnings picture there does not support sort of the V-shaped recovery and the move to new highs that we've seen up to this point in the S&P.
Now, I don't know if it's coming through, but there's a terrible thunderstorm out there. We're not adding that effect to be dramatic. And in fact, it is not all bad news, of course. There are still ways to get ahead in this market. Ted, what are some of your recommendations?
Well, I think the first one is to recognize that as people settle, you don't fight the Fed, and the market hasn't fought the Fed. And that's what has led people to be willing to push stock prices up to these historically high valuations relative to actual earnings. Now, the argument is that eventually these companies will catch up to those valuations based on future earnings. So people are simply willing to pay more for earnings further out than they normally would, which is rational in a mathematical sense if interest rates are this low. The problem is that there are headwinds that are not directly related to even the economy itself. Taxation is one of them. Just general instability, I think, in the regulatory framework, in the global trade framework. And now, of course, we have the resurgence of COVID in certain parts of the world. And so all that means that this notion that people were going to be prepared to buy companies at very elevated levels in return for future earnings, if those earnings don't materialize, what happens to the prices? So my thesis is the stock market has to put its money somewhere. Bonds, it cannot be bonds because interest rates are nowhere. So you'd have to move that money into some other segment. So you go into value, you go into dividend stocks that you can benefit from compounding, as we've been talking a lot about. So I like a couple of different possibilities. I like ETFs like SPYV, which is a value index. If I'm right that people start to shift away, as they already have, from the big caps, they're going to have to put that money somewhere. And so I think they're going to put it there. Another thing is offshore. And an ETF that I like is ACWX, which is essentially non-US equities of all types. Basically, I think people are going to look other places for growth. And even if it's not driven necessarily by growth in the global economy, the money has to go somewhere, and that's where I think it's going to go. Clint, I know you've got some ideas too.
Yeah, so just to jump on the back of your value play, if you want to get exposure to cyclicals, as well as exposure to a high dividend yield, you can look at SPYD. It's a high dividend S&P ETF. Yields close to 6% right now. And when you look at the top weighted sectors, things like financials, REITs, energy, utilities in there as well. So a way to collect income as well as get exposure to sort of that cyclical value play that you're talking about.
And one thing I would also just remind viewers is that when we talk about ETFs, it's not just the ETF. Feel free to go and look them up and look at their holdings. Look at the companies that are actually in those ETFs, because that gives you another way to look at various plays that you could make at a company level as opposed to just the ETF.
Point. Very good point. And again, as a reminder, if you want to find out Ted's favorite income producing investment, actually 3 of them, we have 3 reports we're giving to new members. There's a link below. Make sure you click it. Ted, Clint, thank you.
It's a pleasure. We'll talk again next week.
Thank you.